India's biggest insurer, LIC reported a multi-fold jump in the second quarter profit, coming in at 15,952 crores. The shares surged briefly but later gave up most part of the gains. On seeing the result fine print, it was discovered that a chunk of the profit came from one-time sources. LIC's shares are now 30% below its IPO price, and they have been struggling for a very long time now. Also, the market values LIC shares less than its peers from private sector. So let's try to decode LIC's sustained underperformance and its discount to rivals. First, let's take a look at how insurance companies are valued. For companies from other industries excluding banks and NBFCs, the earnings per share, or EPS as we call it, and the price to earnings multiple based on the EPS is the commonly used parameter to figure out if a stock is cheap or expensive. But for insurance companies, the parameter is embedded value, or EV, and the multiple assigned to the EV. Also, net profit in a given year is not the best indicator to know whether a life insurance company makes for a good investment. In the case of LIC, market has assigned it an EV of roughly between 0.7 to 0.8 times. In comparison, private life insurance companies are valued at around 2 times EV, and in some cases even higher. So why is LIC valued at a discount to its private sector peers? The main reason is the product mix. LIC products are dominated by low-yielding savings products wherein the policyholder will get a defined payout upon the maturity of policy. And private sector life insurers largely have policies or products in the protection category where the payout happens only upon the death of the person. Profit margins on such products are much higher. LIC's products are mainly participating saving products where policyholders can also earn a share of the profits from the policy in the form of bonuses and dividends. Private sector life insurers have more of non-participating products in their portfolio, and so they are able to retain a higher percentage of their profits. What about LIC's massive distribution network of individual agents, over 1 million of them? Doesn't that help sell more policies? Yes. But at the same time, the commission paid to the agents are the highest among all distribution channels, and that affects profitability. Many private sector life insurers encourage customers to buy directly from their websites. Now, this benefits both the company as well as the buyer of the policy, as the commission paid to the agent is done away with. Apart from the embedded value, another metric to evaluate a life insurance business is through value of new business, or VNB. The value of new business gives the investor an understanding of the fair value of the company from the new business that it has generated in a particular period, say over a 1-year period. VNB margins are similar to profit margins of companies in other industries. So what can change the sentiment for LIC? The embedded value in itself may change very slowly for LIC given the huge base of outstanding policies. LIC's embedded value is around 5.5 trillion rupees. Even if LIC has a bumper year in terms of policies sold, that will still be an incremental change only. LIC is working on improving its product mix by selling more of non-participating products as well. If the market is convinced of a sustained improvement in product mix, it will assign a higher EV multiple to LIC. Theoretically, if LIC gets an EV multiple on par with private sector rivals, the stock price could more than double. In addition, if LIC is able to reduce its distribution costs, that should also help its profitability and in turn the market perception. Hope this gives you a better understanding of why LIC's stock price has consistently underperformed over a sustained period of time. That's all we have in this video. Don't forget to like, share and subscribe.